Well, good afternoon, everyone. Thank you for attending the webinar we're running today. The topics that we're covering are 5 tax planning strategies for the 30th of June. Most of you know who I am. My name's Ryan Love. I'll be running the webinar today. It should take us about 20 minutes to get through 5 simple strategies. In terms of structure for today, we can take some questions. If you've got any questions in the control panel on your screen, you can just type in your questions, but we'll come to those at the end of the session. And just so you're aware, we are going to record the webinar today and add it along with a copy of the presentation slides onto our website. So before we get going, there's a couple of important things that we need to run through. Obviously, the information that we'll be going through today is of general nature only. If you've got any specific questions in relation to your own situation, just give me a buzz or give me a call, and we can obviously catch up. We've still got plenty of time before the end of the financial year if we need to do anything specifically for you. In terms of the strategies or the topics I want to cover today, so there's 5, I guess, core strategies that we would think about for clients leading into 30th of June. And the first of that is government co-contributions. The second strategy we're going to cover is salary sacrificing money into super. The third strategy is prepaying some interest on an investment. The fourth strategy is to defer capital gains into a different financial year period or potentially spreading gains over a couple of financial years. And the fifth and final one is to talk about making a personal contribution to super and being eligible to get a tax deduction for that. So without further ado, we'll go through each of the strategies individually. And the first one is a pretty good strategy for those who have got a couple of income earners in the family and potentially someone earning a lower level of income. The government co-contribution, it's a scheme that's been around for a while now. The government has introduced a matched payment structure when you make a co-contribution, when you make a contribution to your super fund. So the government will match dollar for dollar every dollar that you put into your super fund up to a limit of $1,000. So $1,000 is the maximum co-contribution payment you can receive, and there's a series of eligibility criteria for that to apply. So you'll get the maximum payment of $1,000 if your income is less than $31,920 in a financial year. So in other words, if your income's $31,000 exactly and you make a personal contribution to your super fund of $1,000, the government will match that and put $1,000 into your fund also. If your income is between $31,920 and $61,919, the way it works is that you receive a reduced co-contribution payment. So, for instance, if you put in less than $1,000, the government will still match dollar for dollar up to the maximum that applies to you. You're not eligible for a contribution payment at all if your income exceeds $61,919. So we'll go through a bit of an example, and the example I've chosen is pretty appropriate because it's got someone that's earning $45,000 a year in annual income. So obviously that's more than what the maximum co-contribution would entitle you to, so it's more than $31,920, but it's also less than the cut-off rate being $61,919. So from a structural point of view, what you do as an individual, you make a personal contribution to your super fund before 30th of June. So in this example, we've got a person putting $600 into their super fund. When they put that into their super fund, the fund will recognise that that's a personal contribution, and after you've submitted your tax return for the end of the financial year, your super fund and the tax office talk to each other, and the tax office recognises that you're eligible for a co-contribution payment. So in this example, $45,000 is the annual income. The maximum co-contribution payment that this person is entitled to is $564. So in other words, if they put in $550 into their super fund, not $600, they would have received $550. If they put in $564, they would have received $564. So it's always a reduced co-contribution up to the maximum level. But as you can see, they're still eligible for dollar co-contribution payments. So it's quite a good strategy for those that potentially you might be working half a year through maternity leave, for instance, or you might have been out of work or in between work for a period of time. then it works quite well as a bit of a gift from the government to top up your super balance leading into tax time. The next strategy I want to talk about is pretty commonly known as salary sacrificing into super. So salary sacrificing into super simply means saying to your employer, don't pay me the money, pay it into my super fund. Now the benefit of putting money into super is that it's pre-tax dollars. So that the money that goes into the super fund via salary sacrifice is taxed at 15% on entry into super. Now if your personal tax rate is above 15%, so in other words you earn more than $37,000 in a year, this presents a bit of an arbitrage opportunity for you. So for instance, if you earn if your marginal tax rate is 31.5%, obviously that's much higher than a super fund tax rate at 15%. So there's a bit of an uplift there for you. I guess why this is important coming into the end of financial year, a lot of people do get paid bonus payments leading into the end of financial year, and generally speaking, employers will allow you to salary sacrifice the bonus payment. Important consideration when you're thinking about salary sacrifice is that there is a limit as to how much you can do, and if you're aged under 50, the limit is $25,000. And importantly, this includes any other money that's gone into your super fund that your employer's paid throughout the course of the financial year. So it's quite compelling because the super fund tax rate is more than likely lower than most people's personal marginal tax rate. I guess the problem with salary sacrifice money into super is that it's long-term money. It's locked away for quite a period of time until, generally speaking, age 60. So in that context, you need to be able to sort of balance what you need in the short term and the tax savings of putting the money into super for the long term. Diagrammatically, we're going to go through an example with someone that's received a $5,000 bonus payment and has got $50,000 base salary. So in this example, if the employer were to pay that $5,000 bonus payment pre-tax to the individual, on an after-tax basis, they'd receive $3,425 in their bank account after tax. If instead the person says, look, don't pay me, pay my super fund, what happens is that the employer pays the $5,000 to the super fund, 15% contribution tax comes out of the fund, meaning that the net contribution to the super fund is $4,250. Obviously, $4,250 is higher than $3,425. The difference is an extra $825. Now, that's a direct tax saving. That tax saving obviously is held in your super fund. It doesn't flow down to you as an individual. Now, in this example, we've got a person on a 31.5% marginal tax rate. Generally speaking, the more you earn, the more incentive there is to salary sacrifice, because that extra tax saving becomes larger and larger. So salary sacrifice is a good way just to reduce your tax coming into the end of the financial year if you've got a bonus potentially. It is, as I said, a trade-off between putting money into the super, which is long-term money, versus money that you need today in terms of cash flow. So it's working out that balance is different for every person. Strategy 3 that I wanted to talk about involves prepaying interest. So prepay interest, as an individual, you can prepay up to 12 months in advance interest on an investment. So that might be an investment in a share fund, it might be an investment in a property, an investment property as such, where you can prepay interest. Now what that does by prepaying interest, it enables you to bring forward a future year's tax deduction into this financial year. Now when we start to think about that from a planning perspective, it's very advantageous if your salary or income will be reducing in the next financial year. So for instance, if you know that you're going to take 6 months off work next year, then what you want to do is bring forward deductions into this year if you've worked a full year. It also can be advantageous to you if you've realised capital gains this financial year. So you might have sold some shares for a profit, sold an investment property for a profit, so that you know that your taxable income this year is going to be significantly higher than next year. So it does give you an opportunity to effectively shelter, if you like, some of that gain this financial year. Another advantage of looking at prepaying interest is that, generally speaking, you attract a lower rate of interest. The only trap or consideration to be aware of, if you're prepaying interest and you want to sell that investment or look at repay that debt within the 12-month period that you've prepaid, more often than not, you're not going to be refunded the interest that you've prepaid. So you do need to be thinking about this from a planning perspective and making sure that the investment you have is going to carry you forward for the 12 months. Otherwise, it can undo the tax savings. So we'll look at that diagrammatically. And in the diagram, we've got an investment property loan of $300,000 and a 7% per annum interest rate. Now, whether that was an investment property loan, I know at this time of year, there's a lot of, I guess, packaged up share fund style investments where you can borrow money to invest in a fund, and that'll give you a tax deduction this financial year. In essence, it's exactly the same structure. It relies on the prepaid rules. So in this example, we've got $300,000 in a loan and 7% per annum interest rate. So that's $21,000 a year in interest. So what the individual does in this circumstance is they pay the money to the bank before the 30th of June, and that entitles them to claim in their tax return the $21,000 as an interest deduction. So I've got up there a table of what that deduction would be worth to an individual based on various marginal tax rates. So where this is really compelling, I guess, is if you're, for whatever reason, you might have had a good year at work or you've realised a capital gain, that's pushed you into the top marginal tax rate. So if that's pushed you into the top marginal tax rate, that benefit of that deduction to you this financial year is $9,765. But in the ordinary course of business, if you didn't realise a capital gain, you might be in, for instance, the 38.5% tax rate, which means that if you don't prepay, you're only going to get that benefit at 38.5 cents on the dollar, which is $8,085. In terms of financial difference, that's $1,680 in additional benefit to you by prepaying. And likewise, that works down the marginal tax rate scale. So it's important to have a look at what marginal tax rate you've got this year, and then also look at next year and future years in terms of what your marginal tax rate is likely to be. That's prepaying interest. It's been around for a long time. It's relatively easy to understand. Obviously, at this time of year, people do go looking for investments to prepay. So if you don't, you can't prepay your home loan, obviously, but you can prepay anything that is an investment that's designed to produce assessable income for you. So if you're thinking that you need an interest deduction this year and you're looking for investments to prepay, by all means, we'll have a chat